So Ken, what is it you've learned over the last 20 years that you'll be applying for the next 20 years?
No, I think it's just being consistent and staying invested for most of the time. Um, what I work with on my clients is every 3 months or once a quarter, I send out a quarterly report, and this just shows them going back. For instance, we started in 2002 all the way up to 2004, and on my website I have over 40 quarterly reports, and I kind of predict the future. And on some of them, I did really well in the 2002 in the internet boom, but in 2008 I did really well. I was able to get a lot of my clients out of cash, or out of stocks into cash, and really what that means is that my client was able to go to tour Europe rather than sit in the frigid cold here in Kansas City worrying about how the money was going to do. And that's really what it's all about. It's what that money can do, the feelings that it creates, whether working with your grandchildren or children, or developing a business, or doing those trips, that special trips with your wife. And those are the great things that we have. But these are the quarterly reports, and they're right online. It's a matter of record I have under soundinvestments4.com. You can see it in the other literature I have. But these are some of the things that I do. Every 3 months I give kind of a review of the market, where it's going, and what we've done.
So your basic recommendation of staying consistent in the market and forecasting is what you're saying would be the most important part of your history and what you look forward to in the future.
Yes, I think you really got to stay with it, and you got to stay particularly in the trends. For instance, in the 1970s, some of us remember the oil and gas thing. If you weren't in oil and gas, you weren't in the market. But by the time we came to 1982, it was a complete reversal. Oil and gas stocks and gold went down, and they never to return again for another 20 years. And at that time, in the 1980s, you had to be invested in utilities that got the effects. As interest rates went down, they went up in value. And then when we came to the late 90s, you had to be almost invested in the internet stocks. That's what really worked the best. And then from there, you could see the trend going to internationals. And you knew that there was a problem in the housing industry. And when I followed that, I followed the banking industry. I could tell there was going to be a problem. And we had that big crash. And at that point, I was really, in 2008, 2009, I was about 50% in cash. And I have the statistics to prove that, or you can talk to some of my clients. I got a number of references. But some of my clients were really able to spend time in Europe, while some of the other clients were spending, or some of the other people I'm sure were freezing in Kansas City. So it's been able to do those things is what it does. But since then, we've had a market that's been focused on primarily U.S. domestic stocks, and really internationals really haven't done very well. So you got to stay focused in the right area.
What's trending now?
Certainly what's trending now for the last 3 or 4 years is domestic stocks, U.S. domestic stocks. Internationals really haven't done it. They've had a hard time. They've been below it, and they really haven't almost recovered back to where they were in 2007, say, Ron.
Excellent. Thank you.